So what is the best type of mortgage to take? The mortgage market is constantly changing, so understanding your options is really important. In this video, we're going to look at both the fixed and variable options so that you can make the best decision for yourself. My name's Aaron, I'm one of the directors at Create Finance, so let's get into the video. So first of all, let's look at fixed rate mortgages. So what is a fixed rate mortgage? A fixed rate mortgage is a mortgage which has a fixed monthly payment for a set period of time. So that can be as little as 2 years right the way up to the full term of the mortgage. But typically the different terms available are 2 years, 3 years, 5 years, 7 years, or 10 years. Now, depending on the term of the fixed rate also determines the interest rate. So for example, a 2-year fixed rate will have a different interest rate to a 5-year fixed rate. Now, when your mortgage is fixed, that can really help with budgeting, so it's particularly useful for first-time buyers who have never had to make a mortgage payment before. So if you want to know exactly how much you're going to be paying each month and for a set period of time, a fixed rate can be a really good product. Now, the longer that you fix your mortgage for, the less flexible that mortgage becomes. And that's because there's potentially early repayment charges associated with that mortgage. So if you wanted to change your mortgage before the end of the fixed rate term, you may incur a penalty, and that makes the mortgage less flexible. Now, normally the further that you go into your fixed rate period, the lower that penalty becomes. So let's say, for example, you did choose a 5-year fixed rate deal and you cancelled the mortgage with only 1 year left, you would normally have a lower penalty than if you had 4 years left of your fixed rate deal. But again, you need to check that with your lender because different lenders have different criteria when it comes to early repayment charges. Now, a typical early repayment charge that a lender would charge on a 5-year deal is 5% in the first year, and that normally drops by 1% each year, so that in the last year of your fixed rate deal, you would have a 1% fee. But again, check that with your lender. So with some lenders, they do allow the mortgage to be portable. Now, what portable means is moving your mortgage from one property to the next. So let's say, for example, you are in the middle of your fixed rate deal and you want to move home. Some lenders will allow you to move your mortgage from your current property to the next property, and therefore you would not be required to pay any early repayment charges. Also, the longer that you fix your mortgage deal for, the less flexibility you've got as if you wanted to change your mortgage deal. This can be a disadvantage because if rates were to drop, then you would be stuck on a higher fixed rate. However, it can also be a very big advantage because if you fix yourself at a lower rate and interest rates increase, then you will be better off on your current deal. Now, at the moment, most lenders offer fixed rate deals, which means you've got a real big choice in terms of what lenders that you want to approach. So by speaking to a mortgage broker that can access a comprehensive range of lenders, they can make sure that they're choosing the right fixed rate product for you. And finally, another benefit of a fixed rate deal, certainly in the current market today, fixed rate deals as an average are priced lower than variable rate deals. Now again, this can also depend on which lender that you approach. So by reaching out to a mortgage broker and making sure you understand the different deals available is really important. So the next type of mortgage is a variable rate mortgage. Now, a variable rate mortgage is very different to a fixed rate because a variable rate mortgage, the interest rate and the monthly mortgage payments can go up or down, dependent on the product or market conditions. Now again, this can be a great advantage if interest rates were to fall, because if interest rates drop, then your mortgage payments will drop in line with those interest rates. However, if interest rates are to rise, being on a variable rate mortgage can be a real big disadvantage because the mortgage payments will keep on increasing. With variable rate mortgages, there are two main different types of mortgages available. Now, those two main types are called tracker rate mortgages and discounted variable rate mortgages. So let's look at both of those in isolation. Okay, so tracker mortgages, they track the Bank of England base rate. If the Bank of England base rate increases, a tracker mortgage will increase in line with that interest rate. So let's say, for example, the Bank of England increase rates by 0.25%. On a tracker mortgage, your mortgage will also increase by 0.25%, and therefore your monthly mortgage payment will also increase. Now, with tracker mortgages, lenders typically give an interest rate above the Bank of England base rate. So let's say, for example, the product is 1% above the Bank of England base rate. So if the Bank of England base rate is 4.5%, that means the mortgage interest rate that you will be charged is 5.5%. If interest rates were to increase by 0.5%, that would mean that the Bank of England base rate would be 5%, and therefore your mortgage interest rate would be 6%. And that's where you see interest rates and monthly mortgage payments increase. Now again, dependent on which lender that you approach, different lenders offer different tracker deals. So therefore, one lender may be 1% above the Bank of England base rate, another lender may be 2% above the Bank of England base rate. So by speaking to a mortgage broker, you can access a comprehensive range of lenders and then choose the most appropriate deal to your circumstances. So as mentioned before, tracker rates can be risky because if interest rates were to rise, then your mortgage payments will rise as well. A big benefit with tracker deals is, again, dependent on which lender that you approach. A lot of deals don't have any early repayment charges, and that makes them a lot more flexible than a fixed rate deal. So let's say, for example, you're in the middle of your tracker deal and you do find a new property and you want to move to that new property. Well, because there's no early repayment charges, you have no penalties to move your mortgage. So you can either look to stay with your current provider, or you can also look across the rest of the market and find again the most appropriate deal to your circumstances. Tracker deals are also flexible because if also you wanted to pay the full mortgage balance off, again, there would be no early repayment charges. Okay, so the next type of deal is called a discounted variable rate deal. So as mentioned, with a tracker deal tracks the Bank of England base rate. Now, a discounted variable rate mortgage, the lender themselves sets their own variable rate, and this doesn't have to fall in line with the Bank of England base rate. So let's say, for example, the Bank of England base rate is 4.5%, the lender might set their own standard variable rate at 5.5%. Now, if Bank of England increase their rates, the lender doesn't have to increase their own variable rates. And therefore, you could have a Bank of England base rate rise, but with a discounted variable rate mortgage, unless the lender increases their own variable rate, then your mortgage would stay exactly the same. Now again, dependent on which lender that you go to, lenders set their pricing dependent on what their variable rate is. So you may have a variable rate with the lender of 6%, and then their discounted variable rate product is 2% below that variable rate, meaning that the mortgage interest rate that you would be charged would be 4%. So again, this type of mortgage can be really risky because first of all, the lender can set their own variable rate. So without warning, they could increase their interest rate. And if they increase their interest rate, that would increase your mortgage payments. And because it's not in line with the Bank of England base rate, the lender can do that at any time without notice. The reasons why the lender may want to increase their interest rates is because they need to make more money. So lenders are a profit organisation and they need to make more money. And one way that they can do that is by increasing the interest rates of their borrowing, because by increasing their interest rates, it increases the monthly payments, and therefore the lender then can potentially make more money. It may also be that they don't want to take many applications. They might be inundated with the applications, and a way to stop that is to increase their interest rates, so to make them look less competitive. So again, different lenders have different approaches to their own variable rate. So whereas some lenders will change their variable rate monthly, other lenders might not change it for up to 12 months or even longer. So again, because discounted variable rate mortgages are variable, they can also be extremely risky, because if interest rates were to rise, then your mortgage payment would increase. But also a big benefit of a discounted variable rate, they can also be flexible. So there are some lenders that will provide them for you with no early repayment charges. Again, you need to check with the lender before you agree to that type of mortgage and understand what early repayment charges there are if you did want to clear your mortgage. Okay, so what is the right option for you? Well, everybody's different. Some people want fixed rates because they want certainty in terms of what they're paying each month, whereas some others might be happy with a variable rate because it gives them flexibility and they can pay it off sooner if they wanted to do so. but really ultimately the choice is up to you. If you do want more information, reach out to your mortgage broker. They'll be able to explain all the different types of mortgages, the interest rates associated with those types of mortgage, and the monthly repayments. So if you want to find out more information about the home buying process, check out these tips you won't find anywhere else.